as Ari kindly mentioned, I am Cypriot, but you don't need to panic. There won't be any collections or fundraisings today. I am the founder and managing partner of AG Capital Partners, which is a company I set up back in 2007, having spent 15 years in the private equity real estate business in London. The company was founded on one tectonic shift that we were witnessing. Cheap funding was out and asset management was coming back in. So we thought we'd set up a company which would focus, it would be an asset manager at heart. So we thought that we would focus on putting real estate to work. We put in our logo so we can see it every day in the morning, and this is what we are. We're effectively an asset manager. AG Capital Partners has been going strong for 6 years. We're active in Europe and Asia. We've got offices in London and Cyprus, as well as in Hong Kong. We do 3 things mainly. One is investment management. We're managing a portfolio of property on behalf of 2 family offices in Eastern Europe. On the asset management side, we're very busy these days with workouts and mainly helping banks and developers. And also we have a transaction management business, which is essentially investment banking for smaller deals. We've chosen to focus on Southern Eastern Europe, Central Southern Eastern Europe, for 2 main reasons. A, because the banks are in terrible shape, and second, because the space is much less crowded than it is in the rest of Europe. Now, I am going to talk about case studies, just like Ari did, for his own region, but I think it's useful to give you some perspective of what are the differences between the countries you're familiar with, Western and Southern Europe, as opposed to Central and Southeastern Europe. Well, the similarity is that the banks are in a similarly terrible state. They have very stretched balance sheets. The property markets just showed up out of nowhere. You started off with yields of 10, 11, moving down to 6%. We all know the well-known joke. Someone goes to his bank and asks for a loan, 75% on an office, not sure if it's in Bucharest or Budapest. The banks clearly have been following the Coca-Cola paradigm. So they started with covenants regular, moving to light, and then to zero. So what you have today is balance sheets of banks which are in terrible shape, number of assets to be worked out. And clearly, not only they have to address the problems, they have Basel III and other regulatory issues to resolve. One other difference in that part of the world is that most of the lending has been on a bilateral or a syndicated basis. You don't have CMBS, you don't have CMBSs, you don't have conduits. Banking is much more traditional, so you have to deal with bankers, egos, and whatever comes with that. Another fundamental difference is that you do not have the new players who are coming in the UK, Germany, and so on. You do not have debt funds. You do not have insurance companies moving into the debt space. So it's each to his own. The banks have to resolve whatever they have on their books with what is available. I think it was David who mentioned earlier today, and Ari, that legislation is very borrower friendly. Which makes it very, very difficult if you're a bank, if you're an NPL buyer, it's just virtually impossible. Liquidity is very low. Obviously, all the money has evaporated. It's coming back. It has come back to Western Europe, and I don't think there is any credible flow flowing back in. The price gap, what the banks have in their books, based on historical valuations or dreams or whatever, are completely way apart between what the few buyers are willing to pay. And obviously, there's a relative lack of asset management skills. Now, as regards workouts of properties in that part of the world, I think the procedure was very succinctly shown by Ari. The 4 steps you have to take the banks through the whole thing. One thing we need to remember is that in this part of the world, there's no bad banks. I mean, it's traditional bankers. They are very, very alien with the concept of a workout. You just need to take them through the whole thing very, very carefully, measuredly, and explain why it's a good idea as opposed to just sell everything today. We usually work with the banks on individual assets and portfolios. So it's much more painful, it's painstaking, but it has to be done. The first thing you do is the assessment, and of course you have to explain to the banker why his initial knee-jerk reaction just to sell everything because he's not a developer or not an investor is a bad idea. clearly the pricing is completely out of sync with what they have in their minds. There have been a few transactions in the area, for example, shopping centers in Romania, where the bankers have had to take a massive, in the order of 70–80% haircut. So that's clearly not an option. When they go through that, they ask you, okay, how will we sell the NPL? I just don't want to deal with this anymore. Clearly, with the legislation being what it is, the discount you would get on an NPL loan, on an NPL trade, would be just way much than if you had sold the asset, just because you're too removed from actually getting your hands on the asset. The well-trodden path of just doing nothing, trusting the management, pray to God, and hope that the asset will revive itself, hasn't worked. And we do make a point that there are some very asset-intensive assets like shopping centers and hotels and leisure that if you let go for even a month, 2 months, you won't find them back when you come back. So we end up advocating a workout. We all know what a workout is. Essentially, it's an asset management exercise with the aim of, if not reviving the fortunes of the asset, at least stop the deterioration of the performance. The banks don't really like this because they have to commit themselves for the medium to long term. They have to take an interest. They may have to commit capital as well as management time. But the advantage is that they can avoid the immediate write-down, which would have been massive. They might need to take some haircut, debt to equity swap, and so on. But the main advantage is that they can just avoid the write-down. Obviously, the issues to consider here is who puts in the additional equity, because if you are talking to a dead or indifferent borrower, he has no money to contribute. So who puts in the new money, and how do you manage the relationship with the existing borrower? I'll take you to 2 case studies that we have been involved. The first one is a half-completed office development in one of the capital cities in Southern Eastern Europe. Essentially what happened, the development was going fine, the occupier markets stalled, so pre-lets were not happening as they were expected. Meanwhile you had an over-budget situation, so there was just no money to complete it and no income to come in. The development facility was not performing. The borrower was actually a decent, good guy, but he was stressed. He couldn't put in any more money, so everything came to a stalemate. The first thing we advocated the bank is that they try and resolve this on a consensual basis. This is absolutely the first thing you do. There's no point going to courts or pulling out guns or anything. We did carry out an assessment, so the crucial decision was whether it was throwing good money after bad or whether the asset could actually be revived. The result came out positive. You could actually revive the asset. So the question is, what do you do with the capital structure? Clearly, you needed about 15% of the budget to complete the asset. So what we did was to rejig the capital structure. The bank had to reduce the loan down to a palatable level for the new investor. So they had to take a debt to equity swap. The new money came in as mezzanine, which had held priority over the second tranche of the bank, and that got the development going. It was decided that actually the developer should stay in, and I'll tell you why in a moment. So we kept him in, obviously under supervision, and he had to be given a remuneration structure which made it worthwhile to stay in. Now, when it comes to existing borrowers, and this is a very thorny issue, what we tell the banks is, listen, you can really split these people in 3. You have the unlucky ones, the experienced people who have done it before, that were just caught out because the markets had ceased. You have the relevant people, it's business people or whatever, who try to be property developers 2 years before the crash, putting their girlfriends as head of shopping center management. And clearly you had the crooks. And this last category is the ones that you really must remove. Another case study, which is quite interesting because it got a small portfolio of indifferent assets into something substantial, was a portfolio of small hotels in Southern Europe. This is in Greece, but does not involve necessarily Greek banks. Essentially, numerous banks had given loans to a number of hotels, typically small ones, less than 50, 75 keys, in different locations. Neither here nor there. I mean, if you are a hotel investor, you wouldn't really be attracted to that, to buy. They were not viable because they were small, and there was need for capital to get them going. So what we did is, and this is something that we had handled with our partners for hotels, the Hotel Solutions Partnership, was to go to the banks or have a discussion with ourselves and see whether we could aggregate the whole thing into a portfolio. And we thought that if you take all the assets from all the banks and you put them together, you could have something meaningful. So once having gone through the sensitivities, the confidentiality and all that, we had a clear discussion with the bank and said, listen, there's another bank who owns a hotel very close to you or so on. So there could be an agglomeration game here. So everyone came together. We acted as the consolidator. We put the portfolio together and we got it going again because we centralized some key functions like the back office or the management and the marketing and sales services, which actually made it all of a sudden a profitable proposition. It actually became more important for operators and investors, and actually we're now discussing this deal with a couple of investors who want to use it as a platform to get more hotels in the region. And our involvement is still ongoing in the sense that we have shadow management overseeing the whole operation. And clearly, in all examples, the banks want to sell. They are not investors, they're not developers, they just want the fastest way out. Now, going forward, just give my perspective of what I see happening in the region, which may be interested to you either as borrowers or as investors if you have an interest in the region. Are we going to see bad banks like we saw in Iceland or Ireland or Spain? I don't think so. The region is now in the 4th, 5th or 6th year of recession, depending on which country you're examining. There hasn't been a trigger for a bad bank. I mean, in certain countries like Cyprus or Greece, the Troika has been advocating or pushing for a bad bank, but we just haven't seen it happening. If it happens, I think it's going to be still a trickle. You're not going to see massive quantities of assets, so I'm not very optimistic on that. Ari made a very, very crucial point about the management of the assets. The banks think that they can recycle their staff by putting them to managing assets. It's actually a completely different animal. It's one thing being a banker and a completely different thing being an asset manager. And I think the banks are coming to realize that. Clearly, you do have a deleveraging and you don't have the new debt sources to act as a cushion. So I think things are going to happen faster in that region. You do have to incentivize the local teams to perform, be that internal people within the bank, the asset managers, and so on. And the final point is that the region has been off the radar screen for pretty much everyone. I mean, everyone in this room, or 90% I'm sure, you're looking at the UK, at France, at Germany, Netherlands, and so on. This is a good thing and bad thing. I mean, if you ask 10 doctors about the medical condition and 8 of them converge, you know this is the thing to do. If you ask 10 investment managers on what to do and 8 give you a certain opinion, you surely should do a different thing, the opposite thing. So, for as long as there's no money, I think there's good opportunities to be made. This is to the detriment of the banks, who would have hoped for liquidity, but as a matter of fact, they are now coming to the realization that equity does really cost 20% if it comes their way. So, unfortunate for the banks, but this is a fact of life. There's very little equity, there's opportunities to be made, and this is going to keep the workout strong for the next 5 or 10 years. That's all I have to say. I'll take your questions at the end of the session. Thank you all very much.
Great. Thank you.